My name is Fred Muremi. I'm the managing partner of Centum Capital Partners. So CCAP, which is Centum Capital Partners, is the private equity arm of Centum Investment Company Plc. So we have been investing in private equity since Centum began 52 years ago, and that's what we've been doing. The private equity class is where we're looking to invest into the equity of private companies as opposed to publicly listed companies. So for CCAP, like I mentioned, we've been investing in private equity, or what is today known as private equity, since 1967. We've been fairly active. If I look back at the last 10 years of Centum Capital Partners, we've possibly been one of the most active private equity managers in this region. We've had 15 investments over the last 10 years. So far, of those investments that we've made over the 15 years, we have been able to exit 10 or realize our investment in 10 out of the 15. In that process, we have also returned quite a bit of capital back to Centum. Over the 15 years, Centum has been able to invest about 13 billion shillings into the private equity portfolio. To date, we have been able to return back to Centum from the original 13 billion shillings. We have been able to return back to Centum almost 48 billion shillings in the last 10 years, and still have a remaining portfolio value of roughly about 7 billion shillings. So Almasi is one of the private equity companies that we have been invested in for a long time. It was actually the formation of three Coca-Cola bottling companies that we had been invested in, that is Mt.Kenya Bottlers, Rift Valley Bottlers, and Kisii Bottlers. So back in 2012, we as a shareholder, common shareholder in the three bottling companies, thought it would make economic sense to consolidate the three bottling companies. We had analyzed each of the three. We had seen opportunity to grow the respective businesses, to grow from a common platform, but also make rational investments across on a shared basis on the three, and also bring in a strong management team within the three bottlers. So that's a journey that we began in 2012. We had to do quite a bit of work convincing the other shareholders in the three bottling companies on the case for merging the three bottling companies. Some readily accepted, others took longer on that journey, but we set off. So back in 2013, when we then effected the merger, Centum had about a 30% share of Almasi. Over time, we then increased our shareholding in Almasi to a controlling stake of 53%.
I have been in this business for the last 27 years. I joined this company in 1993, having worked in the Standard Bank, having worked also in Car in General, and having a bit of experience also from the government. I worked in Treasury throughout my career journey. I joined Mt.Kenya Bottlers as an accountant. I am an accountant by profession, and I have grown through the landers. As the organization have grown, have also given me opportunity to grow up to where I am today as a Chief Executive Officer of Almasi Beverages Limited. It's been a beautiful journey which I have enjoyed, and I thank God for the grace to go through that journey. Almasi Beverages Limited is a holding company for Almasi Bottlers. In 1976, 1977 and 1986, the shareholders of Almasi Beverages formed three bottlers. That was Mt.Kenya Bottlers, Rift Valley Bottlers, and Kisii Bottlers. In 2012, through a transaction that was led by Centum, the shareholders came together and formed Almasi Beverages to own the assets of the three bottlers through a share swap that was done. So the shareholders of the bottlers swapped their shares for the shares of Almasi Beverages. And so Almasi Beverages now owns the 3 plants. That is the plant in Nyeri, a plant in Eldoret, and a plant in Kisii. That is Almasi Beverages. In terms of production capacity, Nyeri is the biggest. In terms of area, or what you call the territory, Rift Valley is the biggest. And Kisii is a reasonable size. Almasi is a franchise of Coca-Cola. So Almasi bottles, manufactures and distributes Coca-Cola beverages. That is the soft drinks, the water, which is the Sunny, and also the juices we call Minute Maid. And currently, Coca-Cola also is in the verge of diversification, introducing a lot of products, products with coffee, products with energy, and also like Powerade, and very many new products in terms of the customers' demand. So basically, Almasi does everything Coca-Cola does in Kenya.
My name is John Simba, and I'm a lawyer by profession, practicing law as a senior partner at Simba & Simba Advocates. And before that, I've been involved in other institutions, but the one that will be of greater interest for the conversation we have before us is that I worked for Industrial and Commercial Development Corporation for about 13 years, ICDC. And it is during the time that I worked for the giant corporation that I then got involved as a lawyer for ICDC, and as part of project teams that were involved in setting up projects, that I got involved with Coca-Cola and the bottling plants that now constitute Almasi Beverages. We set up Mt.Kenya bottlers up in Nyeri, and I was on the board representing ICDC. And at one time later, I briefly chaired the board of Mt.Kenya bottlers. And also ICDC put up Rift Valley bottlers, and I sat on that board for a couple of years. And later, the last one that was put up by ICDC was Kisii bottlers, and I was chairman for many years actually. And in all these 3 bottling plants, ICDC Investments, which we now know as Centum, was deeply involved in providing project finances, and as a shareholder as well. And therein then began my relationship with these 3 bottling plants, which later collapsed into one institution we now call Almasi Beverages Limited. And in all the 3, Centum was and has always been a very critical owner of these companies.
I am James Moria. I'm the Group Chief Executive Officer of Centum Investment. I was until recently the Chairman of the Board of Directors of Almasi Beverages. You know, Almasi is an interesting story. I first engaged with the various bottlers that then became Almasi way back in 2005 when I was the investment manager of ICDCI. The companies were Mt.Kenya bottlers, Kisii bottlers, Rift Valley bottlers. They were different companies, and ICDCI, which is now Centum, had minority shareholding in the 3 of them. I was given an assignment by the then CEO to go there when I was a young investment manager in ICDCI to go and look at what we could do to optimize the value of the three companies. And I spent a lot of time visiting the three plants, and the opportunities were unbelievable. But it took us almost from 2005, when we produced the initial report, to 2009 to start actualizing that journey, by which time I was the CEO of Centum. And so our focus as an organization is to help companies achieve their full potential. And these particular three companies were companies that were significantly underperforming. And so the first step of that journey was bringing them together to merge to create one entity. And that merger process probably took us a year or two. We only concluded about 2011, having worked on it for 2 years.
So for us, we have 5 touch points when you speak about value creation. So any business that we analyze, we see if we apply any of those or all of those 5 touch points, we then quantify what is the possible value that could be created. The 5 touch points are: number 1 is the opportunity to enhance revenue. If I go back to the case of Almasi, the revenue enhancement came primarily from being able to increase capacity, production capacity, but also increase distribution capacity. Because it's one thing to have the production capacity, but if you're not getting a product out, then it doesn't translate to sales. The second is to then improve margins. The margins will come as a consequence of how much you're actually producing, but also are there opportunities to reduce costs. So for instance, in the case of Almasi, by creating one management team, one platform for distribution, also rationalizing where we do the production, we were then able to save certain costs, which improved the margins of the business. So if I look at the EBITDA margins, that's a common term in our world of private equity, the earnings before interest, tax, depreciation, and amortization. In 2012, the EBITDA margin was 10%. So for every 100 million shillings, we were earning, for every 100 million shillings of sales, we were earning 10 million shillings in EBITDA. We then moved the EBITDA margin from 10%, that was in 2012. By 2018, the EBITDA margin had grown to 28%, which means from the same 100 million shillings of sales, we are now making 28 million shillings, up from the 10 million shillings that we were making in 2012, which came again from just the benefits of the merger, rationalization, and the efficiencies. The third is being able to deploy capital more efficiently. And the capital deployment could be in the form of expanded production capacities. It could also be in the form of new equity coming into the business to support the expansion program. It could also be, as far as debt funding is concerned, being able to source debt cheaper. And for us, because we have a network of financiers that we work with, we're able to source debt cheaper than a number of standalone businesses could. Okay, so if you're able to save on interest expense, that already is another way of creating value for the business. The fourth then is on corporate governance. And on corporate governance, what we do is to strengthen the institutions, operations, processes, policies, and people. Okay, so what we are looking at there is, are we able to bring in a stronger management team? Are we able to refine the processes? Are we also able to reduce areas of wastage or pilferage as well? Because if you're able to save 10 shillings every day, for instance, just by reducing pilferage, wastage, and the like, that's a lot of value that is being created. Then the last is to reduce risk. Risk could be internal, could be external. If I look at external risk comes from regulation, from tax, from the legal environment. And because we have a very broad network of contacts that we have formed over the 50 years that Centum has been around, we are then able to work with the businesses to manage the external risks that could be posed to a business. So in any business that we are looking at, Even in the case of Almasi, for instance, we worked with them to be able to manage just some of the tax exposures, to be able to manage some of the regulatory exposures that were coming through. So that's what we look at. So in any business, we go in and look at, of these 5 touch points for creating value, are we able to create value? So the value creation is almost a second step. The first step is this a company that we even want to spend time looking at? Okay. And what we look for in that first step is we look primarily for companies that are market leaders in their respective segments, which means they've already won with their customers. So if I go back to Almasi, for instance, in the territories that it was distributing product to, Coca-Cola had an over 90% market share. So already it was a market leader. We then look at, is there a competitive edge that this business has, which is not easily replicated by other businesses. Once those first 2 are met, and then the third one is then also, will this company be strengthened by having Centum as an investor in the business? Because there could be a market leader, but if we come in because of either our corporate governance practices, our style of leadership, we might actually make the company less competitive in the market. Okay, so once we clear through that first step, that's now when we spend more time analyzing what is a value creation strategy that we can then deploy into each company. So for us at Centum as an investment company, because we know one day eventually we are going to exit that business, our parenting model is to make the companies independent and strengthen them at their level and not to be Centum reliant. Because if they are Centum reliant, at the point that we want to exit, that one day we'll not be able to exit because the company relies on Centum. So we look at strengthening the management of those companies. We look at strengthening the boards of those companies. We look at strengthening the processes of those companies, but in ways that speaks to their industry. So at Centum, we are investment people, which is a very different skill set from selling soda. So we look and see what is the best management, what is the best governance that is applicable to the sale of soda. And that's how we then empower those companies. So it's not reliant on Centum. What we do is just to ensure that the governance processes are world-class. That if it is a training, that they're getting exposure to world-class training that is relevant to the industry that they are in. If it is processes and systems, if the best standard is, say, an ISO standard, we then get those companies to adopt those standards relevant to their industry. So we don't necessarily want to take a Centum way of doing things. What we identify is what are the value creation points, what kind of processes, people, systems do we require to be able to unlock that value, but especially what is relevant to that industry. And the parenting style for us is to make the companies independent of Centum.
I was given an assignment by the then CEO to go there when I was a young investment manager in ICDCI, to go and look at what we could do to optimize the value of the 3 companies. And I spent a lot of time visiting the 3 plants, and the opportunities were unbelievable. But it took us almost from 2005 when we produced the initial report to 2009 to start actualizing that journey, by which time I was the CEO of Centum. And so our focus as an organization is to help companies achieve their full potential. And these particular 3 companies were companies that were significantly underperforming. And so the first step of that journey was bringing them together to merge to create one entity. And that merger process probably took us a year or 2. We only concluded about 2011, having worked on it for 2 years. The second challenge we had is that because we're all minorities, there was no clear driver of the business. And so decision making was very slow. execution of strategy was by consensus. It would typically take a long time. And so the second aspect of this, as part of the merger, was for Centum to increase its shareholding, so that then we'd get a controlling shareholding in the combined entity. So when we started the process, we were probably around 27%. By the time we were done, we had gone to 54%. Now, when we looked at the potential for value creation in that particular business, what we could do to optimize value, and we do this for not just for the shareholders, we do this for all the stakeholders. The staff have to buy into what it is you're doing. There has to be benefit to them. We had a key franchise partner, Coca-Cola, who we had to bring on board, because that's a key stakeholder of the business, to see what is in this for you. There was the local communities where we were operating in the three different counties. So it was a bit of a complex thing, but it had to make sense for everybody.
I've told you I've been in this business since 1993, and it's been a long journey. That time we were running a single business. I was running Mt.Kenya, and the other three bottlers were running independently. A lot of sub-optimization of utilization of assets, no collaboration, and the shareholders were basically the same.
There were several challenges we had at the time when we started. One, we were still selling only soda, a carbonated soft drink, in glass. We did not have manufacturing capability in PET, which was a more convenient pack and was a growing pack. In fact, our competition was growing in the PET segment. We had not diversified into water. We had not diversified into juice. So there was a product diversification element. And what had held that back was a lack of investment in the business. And what had held back the lack of investment in the business is because these three businesses were operating as separate businesses. None of them had the scale to make the investment. So in essence, they had become wholesalers. They would buy products from other bottling companies to resell in their territory. And because these products were at a lower margin, that was not the core focus. The core focus was to sell their own products. And so we were losing share in that segment of the market, and also not giving our customer the full basket. And also because you are sourcing from another bottler, you have a lot of product stockouts, because you only get the product when the other bottlers have surplus capability. So therefore, the first element of the business was then to raise the necessary capital to make those particular investments. And we made those investments in the Nyeri plant, where we invested in a state-of-the-art PET factory. We did an RGB factory. We then even refurbished all the existing lines to make sure we could have the entire product range. When we did that, then the next challenge became distribution. How do you now get these products to the market?
The case that we saw, like I mentioned, we see opportunity to enhance revenue. The enhancement of revenue was going to come primarily from being able to expand capacity of the three bottling companies. We saw opportunity to also improve margins in the business. So if I take the example of the PET bottles, that's the plastic bottles, we were within the three bottlers, each of them was buying from different bottlers outside of the three bottlers, and the margin that we were making was quite thin. So we took the decision, which was part of the case for merging the three bottlers. We took the decision to invest in our own line. That decision moved the margins from something like 16% to almost 45%. We also saw opportunity to invest in our own distribution. So if you think of the long distances that Almasi territory covered, because we're distributing in 24 out of the 47 counties of Kenya, and the bulk of it was being transported using hired transporters, which was at times unreliable, so we made the decision to invest in our own fleet. That improved the turnaround of the delivery of the soda. Even the farthest distance was covered within 24 hours, which is important because if you think of the consumer, if I go to a kiosk and don't get my soda today, tomorrow if I get it, I will not drink two because yesterday I didn't get soda. So soda has to be available all the time, every time. So the investment in distribution was very important. Investment in people as well was critical. People both at the management level and also at the board level. So at the people, we were able to promote one of the managers of one of the plants to become the CEO. The lady was very well versed with the system and able to empower, strengthen, and create a strong leadership team at the top. And that saw them increasing performance, volumes went up significantly. We were able to then now support them with the investment program that we had already identified. At the board level, we also then rationalized, created one board for all the three companies so that there was unity of purpose and a shared sense of value as well. So there was quite a number of touch points that we had for us in the journey of creating Almasi.
I remember this because I also know the challenges that we faced, challenges of putting resources together. Because, you know, at the end of the day, it's not everyone who can run an institution. You need some very special people to do that. And I think we were able, with the help of Centum, to realize this specific goal on procuring resources that we needed.